US just made one of the biggest economic miscalculations in modern history? It thought it could pressure Canada into submission with aggressive trade restrictions, but instead it triggered a backlash that could reshape the entire global economy. Canada's $155 billion counterattack isn't just hurting American businesses, it's exposing vulnerabilities in the United States' economic dominance. And this isn't just about governments and policies, it's about you. The fallout from this economic war is already affecting prices, industries, and job markets. How will this impact you as a consumer? Will cars become unaffordable? Are we about to see a complete shift in trade partnerships? And most importantly, can the United States recover before it's too late? Stick with me, because what you're about to learn could completely change how you see the future of the global economy. And trust me, the final piece of this puzzle is something no one is talking about, but it could determine everything. The United States picks a fight it cannot win. On the surface, it seemed like a strategic move, designed to crack down on illegal crossings and enforce tougher immigration policies. However, the true motivation behind these tariffs was not about security. It was a clear economic maneuver to pressure Canada and Mexico into submission. The government believed that by applying financial pressure, Canada would cave and negotiate on terms favorable to the United States. But this strategy underestimated one key thing: Canada's resilience. The administration assumed that Canada would absorb the blow and eventually come to the negotiating table. But the reality was far different. Canada was not going to bend to economic coercion. Instead, what happened next sent shockwaves through the global economy and triggered a series of events no one could have anticipated. Canada was not about to back down. And what happened next would change everything. Canada's $155 billion counterattack, a calculated strike. Trade wars are never one-sided. But Canada's retaliation was different. It was surgical. In response to the aggressive tariffs imposed by the United States, Canada unleashed a powerful $155 billion counteroffensive, striking directly at United States exports. Unlike the broad, unfocused tariffs from the United States, which hit almost every Canadian sector, Canada's response was targeted and strategic. The first phase of this retaliation, valued at $30 billion, was implemented almost immediately. The focus was clear: target key industries that were not only economically vital, but also politically sensitive. By choosing to impose tariffs on sectors with strong lobbying power, Canada sent a clear message to Washington that it would not simply lie down and accept the terms of the trade war. The United States had wrongly assumed that Canada's dependence on trade would force the country into submission. But the tables were turning fast. This retaliation was no longer just about punishing the United States for its trade aggression. It was about making Washington feel the pain where it hurt the most. With billions on the line, industries from agriculture to technology were now under pressure. And this was just the beginning. This was not just about fighting back. It was about making the United States feel the pain where it hurt the most. The automobile industry faces an immediate collapse. The first industry to fall? The nation's automobile giants. The automobile sector, already reeling from the global supply chain crisis, found itself directly in the crosshairs of Canada's tariffs. Manufacturers like Ford, General Motors, and Tesla were suddenly forced to confront the economic consequences of the trade war. Increased tariffs on automobile exports meant that Canadian consumers now faced higher prices for vehicles manufactured in the United States. This reduced demand for American cars in Canada, a crucial market, and put manufacturers in a precarious position. But that was not all. The tariffs imposed by Canada also created massive logistical disruptions. Supply chains that stretched across North America were suddenly tangled. Parts and raw materials from Canada that were essential for automobile manufacturers were now subject to higher costs, and companies were struggling to absorb these expenses. Production delays became inevitable, and manufacturers scrambled to find new suppliers or adjust to the increased costs. As automobile manufacturers faced mounting pressure, their stock prices began to fall. The repercussions were being felt throughout the sector, from the factories on the assembly lines to the workers on the ground. What seemed like a minor trade conflict was rapidly escalating into an economic storm. But what started in the automobile industry would not stay there for long. The damage was spreading fast. The unintended consequences no one saw coming. Washington thought it was in control, but then the trade war spun out of control. As tariffs took hold, the impact started to ripple through every corner of the economy. Raw material shortages began to hit manufacturing sectors hard. Factories that relied on Canadian steel, aluminum, and automobile parts were now facing severe delays, leading to a domino effect of supply chain disruptions. The costs of these imports were rising sharply, and businesses were struggling to decide whether to absorb the costs or pass them on to consumers. The latter seemed inevitable, but it was not just the manufacturing and automobile sectors that felt the pain. Across the board, industries were experiencing the fallout. In agriculture, the effects of Canadian tariffs on exports were deeply felt, leading to a glut of products in the domestic market. Surplus goods like beef, pork, grains, and dairy flooded grocery stores, causing prices to plummet. As a result, farmers struggled to turn a profit, with some even facing financial ruin. In other sectors, companies began laying off workers in response to shrinking profits, and fears of a wider recession began to grow. Rising costs were not just affecting businesses, they were starting to hit consumers as well. Prices for everyday goods, groceries, electronics, appliances, began to increase. The economy was being pulled in different directions, with rising unemployment and financial uncertainty growing by the day. The administration's decision to impose tariffs, initially framed as a strategy to strengthen national security, had now morphed into a massive economic crisis that no one could have predicted. The pain was being felt across the board, and it was not just about numbers on a spreadsheet anymore. People were losing their jobs, prices were rising, and the future of trade was more uncertain than ever before. And this was just the beginning. The real shockwave was about to hit consumers. Why everything just got more expensive? If you think this trade war only affects businesses, think again. The moment tariffs were announced, the price of almost everything started climbing. It was not just car manufacturers feeling the pressure. It was every American household. The cost of groceries went up, electronics became more expensive, and even basic household goods were no longer as affordable as they once were. But how did it happen so fast? Tariffs work like a tax on imported goods, forcing companies to pay extra just to get their products across the border. But businesses rarely absorb these costs themselves. Instead, they pass them directly to the consumer. The result? Car prices surged, as manufacturers paid more for Canadian steel and aluminum. The average cost of a new vehicle jumped by thousands, making financing even more difficult for buyers already struggling with inflation. Used car prices, which had previously skyrocketed due to supply chain issues, saw no relief. But it was not just the auto industry that suffered. Grocery store shelves became a battleground for higher prices as well. American supermarkets rely heavily on Canadian food products, including dairy, beef, and grain. With new tariffs in place, retailers were left with two choices: absorb the added costs or raise prices. Most chose the latter. The cost of milk, cheese, and eggs increased, forcing families to stretch their budgets even further. Meat products followed, with beef and pork prices climbing due to the sudden disruption in supply chains. Electronics and appliances took a hit as well. Many of the raw materials used to manufacture consumer products come from Canada, and with tariffs in place, everything from smartphones to refrigerators became more expensive. Retailers started warning of price hikes, and shoppers looking for deals found themselves out of luck. The impact of the trade war was no longer something happening behind closed doors in Washington. It was sitting on every store shelf, waiting for the next customer to notice. But rising prices were just the tip of the iceberg. What came next was even worse. The collapse of American factories and layoffs began. Thousands of workers woke up to pink slips. This was the new reality. Manufacturing plants across the country were already struggling with global supply chain disruptions, but the trade war with Canada pushed them over the edge. The first wave of layoffs came from the automotive sector. Factories in Michigan, Ohio, and Kentucky began cutting jobs as production costs surged beyond sustainable levels. Ford and General Motors were among the hardest hit, with both companies announcing immediate workforce reductions to offset rising expenses. But it did not stop with automakers. The ripple effect extended to parts suppliers, logistics companies, and assembly plants that relied on steady imports from Canada. Manufacturing jobs had been some of the most stable in the country, but now thousands of skilled workers were being forced to look for employment elsewhere. Some found themselves turning to temporary work, while others had no choice but to rely on government assistance. For many, this was not just about losing a paycheck, it was about losing a career. The lobbying efforts began almost immediately. industry leaders flooded Washington with urgent requests to reverse the tariffs, warning that further job losses were inevitable. Business owners testified before lawmakers, explaining how supply chains had been severely disrupted. Despite the pressure, the government stood firm, insisting that the tariffs were necessary for economic security. But for the workers left without jobs, there was nothing secure about their future. And as jobs disappeared, another silent crisis was already brewing: the tourism boycott, a silent billion-dollar weapon. Canada was not done yet. Now it was time to hit the United States where it never expected: tourism. Every year, millions of Canadians cross the border for vacations, shopping, and business. The United States had long been one of the top destinations for Canadian travelers, with cities like Miami, Los Angeles, and New York benefiting from billions in tourism revenue. But that all changed when Canadian leaders called for a travel boycott. Government officials urged citizens to rethink their vacation plans, encouraging them to spend their money at home instead of supporting an economy that was actively harming Canadian industries. Travel agencies reported a sharp decline in bookings, and airlines began seeing an unusual number of cancellations for flights to American cities. At first, many dismissed the impact, believing it would be minor. But within weeks, the numbers told a different story. Florida, a state that relies heavily on Canadian tourists, was among the hardest hit. In previous years, Canadians made up a significant percentage of foreign visitors, contributing billions to the local economy. With fewer travelers arriving, hotels, restaurants, and theme parks started seeing revenue drops. Casinos in Las Vegas, which had long been a favorite destination for Canadian tourists, reported declining attendance. The impact stretched beyond tourism hubs. Local businesses that depended on seasonal visitors were now struggling to stay afloat. The boycott was not just symbolic, it was a financial weapon. The loss of Canadian visitors meant fewer hotel stays, fewer restaurant meals, and fewer dollars spent in American stores. Business owners who had once supported strong trade policies were now questioning whether the tariffs were worth the economic pain they were feeling. And the worst part, the damage was not limited to tourism. It was spreading into another critical industry. American farmers are caught in the crossfire. Farmers in America already had a lot to worry about, and now Canada's tariffs made things even worse. Agricultural exports to Canada had been a lifeline for many farmers, providing stable income and steady demand. But after the retaliatory tariffs were put in place, that demand collapsed overnight. Grain farmers in the Midwest suddenly found themselves with an oversupply of crops that they could not sell at profitable prices. Without Canadian buyers, wheat and soybean prices dropped, forcing many farmers to operate at a loss. The dairy industry faced similar struggles. Canadian restrictions on American dairy products made it difficult for farmers in Wisconsin and New York to maintain their businesses. For some, decades of hard work were at risk of disappearing. Livestock farmers were no better off. Beef and pork producers, who had long relied on Canadian markets, were now dealing with a glut of unsold meat. The surplus drove down domestic prices, making it even harder for small farms to stay afloat. The financial strain forced many farmers to cut costs wherever possible, selling off equipment and reducing their workforce. Others faced the grim reality of shutting down entirely. As economic pain spread, even state leaders started turning against Washington. Governors from agricultural states joined forces with business leaders to demand change. They argued that the tariffs were not just hurting Canada, they were devastating American industries. But despite the mounting pressure, the government remained committed to its trade war strategy. The question now was simple: how much more economic damage would it take before Washington reconsidered its approach? Governors are turning against Washington. For decades, states followed federal trade policies without question. Not this time. When the economic impact of the tariffs hit, it was not just businesses that felt the pain. Governors of trade-dependent states were now facing a political nightmare. The automotive heartlands of Michigan and Illinois were seeing factories cut shifts and lay off workers. In Texas, agricultural exports to Canada were drying up, leaving farmers with unsellable surplus. Even governors who had initially supported the federal government's trade agenda were now changing their tone. The economic fallout was too severe to ignore. Michigan's leadership was among the first to push back. With auto manufacturing making up a massive share of the state's economy, the effects of the trade war were immediate. Assembly plants were slowing down production, and suppliers were reporting declining orders. Workers who had once felt secure in their jobs were now receiving termination notices. The governor's office released a statement calling for urgent negotiations, warning that the longer this trade conflict continued, the deeper the economic damage would become. In Texas, where trade with Canada was a significant part of its economy, the situation was escalating quickly. The state had long been a major exporter of oil, agricultural products, and manufactured goods to Canada, and the tariffs were strangling those industries. Farm equipment sat unused in fields as grain and beef exports faced sharp declines. The governor, initially aligned with the federal administration, was now voicing concerns about the damage done to farmers and businesses. Press conferences were held, letters were sent to Washington, and pressure mounted for a reversal of the tariffs before the damage became irreversible. Illinois, a major player in both agriculture and manufacturing, was experiencing similar turmoil. Its exports had been hit hard, and layoffs were spreading across industries. State officials were meeting with business leaders to assess the damage, and the results were alarming. The economic backbone of these states was under threat, and Washington's unwillingness to adjust its stance was leading to frustration at every level. Despite mounting pressure from these key states, federal officials remained firm. The belief in Washington was that the tariffs were a necessary tool to secure long-term economic advantages. But as frustration boiled over, it became clear that the governors were not alone in their growing opposition. The auto industry, already on the brink, was preparing its own counterattack. The U.S. auto industry begs for a bailout. Ford, General Motors, and Tesla thought they could weather the storm. They were wrong. The tariffs had driven up the cost of essential components. And with Canada imposing its own retaliatory measures, American-made cars were suddenly much more expensive in one of their biggest markets. Sales plummeted, dealerships struggled to move inventory, and manufacturers were left with no choice but to make drastic cuts. Layoffs began hitting major production plants across the country. Assembly lines were slowing down, and supply chain disruptions meant that even vehicles already in production were facing delays. The rising cost of steel and aluminum, much of which had previously come from Canada at lower rates, was driving manufacturing costs to unsustainable levels. Companies scrambled to find alternative suppliers, but nothing could match the efficiency and affordability that the previous trade agreements had provided. Faced with an industry-wide collapse, automakers turned to Washington for help. Executives met with lawmakers, urging them to reconsider the tariffs or provide immediate financial relief. A proposal was put forward for emergency government assistance to stabilize the sector. But the debate over whether the federal government should intervene in the crisis created even more division. For Washington, this was a nightmare scenario. The same policymakers who had championed tariffs as a tool for economic strength were now being forced to consider costly bailouts for an industry that was suffering because of those very policies. The question was no longer whether the trade war would hurt the economy. It already had. The real concern now was whether Washington could stop the damage before it was too late. As lawmakers debated bailout options, something even more alarming was happening. Wall Street, watching the chaos unfold, was beginning to panic. Stock markets react. Investors are running for cover. The markets thrive on stability. This trade war was anything but stable. As news of factory closures, mass layoffs, and declining exports spread, investors started pulling out of key industries. The automotive sector saw its stock values tumble, but it was not alone. Agriculture, which had already been struggling under the weight of reduced trade, was also feeling the shockwaves. The manufacturing sector, reliant on both domestic and international supply chains, was experiencing its worst downturn in years. Financial analysts warned that investor confidence was at risk of collapsing if the trade war did not find a resolution soon. Some of the largest hedge funds and institutional investors began repositioning their portfolios, moving away from American companies that were exposed to trade volatility. The uncertainty surrounding the federal government's response to the crisis made matters worse. Without a clear plan to address the economic fallout, speculation and fear took over, further driving down stock values. Corporate leaders were publicly voicing their concerns, warning that if the government did not take swift action, the markets could face a downturn that would take years to recover from. Some industries were already preparing contingency plans, looking at overseas expansion or shifting production to avoid the financial strain caused by the tariffs. But for many American businesses, there was no easy way out. out. The damage had been done, and the effects were rippling across the economy. As Wall Street burned, a bigger question was beginning to emerge. Was this just a temporary crisis, or had the United States lost something much greater? Its global trade dominance. Is this the end of American trade dominance? There is no denying that the United States has been totally dominating global trade, but now it seems like things are about to change. What had once been an economic powerhouse with unmatched influence in international markets was now struggling to maintain its standing. Countries that had previously depended on trade agreements with the United States were beginning to look elsewhere. Canada had already started strengthening its economic ties with Europe and Asia, reducing its reliance on American trade. Mexico, another key partner, was also expanding its trade relationships beyond North America. The European Union, watching the escalating crisis, had begun re-evaluating its own economic dependencies. Major trade deals that once centered around the United States were now being reconsidered, with some nations actively seeking to lessen their exposure to American economic policies. This was more than just a trade war. It was a shift in global power dynamics. The question now was whether the United States could regain its standing, or if this was the moment that marked the decline of its economic dominance. The world was watching closely, and so were other nations that had long accepted American trade supremacy. If Canada could successfully challenge the United States and emerge stronger, who else might follow? The economic fallout was far from over. Washington had started this trade war believing it could force its way to a better deal. Instead, it had ignited a crisis that was reshaping the balance of power in ways it never anticipated. The question now is how much longer the United States could afford to hold its position before the consequences became irreversible. And is Canada the first of many to stand up to the United States? What's the future of this war? Canada proved something Washington wasn't ready to hear. The United States isn't untouchable. For decades, the United States used its economic power to set global trade rules, expecting other nations to comply. But now the retaliation from Canada has sent a message far beyond North America, one that other countries are starting to pay attention to. If Canada can push back and make the United States feel the consequences, what is stopping others from doing the same? Mexico, a key trade partner heavily reliant on the North American market, has watched this conflict unfold with growing interest. If the United States is willing to impose sudden tariffs on a close ally like Canada, what is stopping it from doing the same to Mexico? The Mexican government has already begun strengthening economic ties with South American countries and expanding agreements with the European Union to reduce reliance on the United States. The European Union itself, a longtime trade rival of Washington, has been dealing with United States-imposed tariffs on steel, technology, and agriculture. Now, with Canada showing that economic retaliation can work, European Union leaders are discussing more aggressive responses to unfair trade practices, even exploring stronger partnerships with China to shift away from reliance on the United States market. China, already locked in a trade battle with Washington, has taken note of Canada's tactics. Beijing has long been subjected to economic pressure from the United States, but Canada's strategy of targeting politically sensitive industries has provided a new playbook. Chinese officials are now exploring ways to inflict similar targeted economic pain on the United States, particularly in sectors where American businesses are most vulnerable. The idea that smaller nations must simply accept economic pressure from Washington is fading. Canada may have just set a precedent for a new global trade order, one where retaliation is the norm rather than the exception. And this shift isn't just about policy, it is about power. The world is watching. If one country successfully resists economic coercion from the United States, others will follow. The question now is not whether more nations will push back, but how soon they will. And as this new trade landscape takes shape, one industry in particular is already feeling the pressure: the automotive industry. Once a pillar of economic strength for the United States, is now facing an uncertain future. Canada's retaliation has exposed deep vulnerabilities in American car manufacturing, and if the industry does not adapt, it risks losing its place in the global market. European manufacturers are accelerating their expansion into North America, offering alternatives to frustrated consumers. Meanwhile, Canada is deepening its partnerships with the European Union and Japan to source vehicles and parts, further reducing reliance on the United States. China, the world's largest producer of electric vehicles, is seizing the opportunity to dominate the market. And then there is the consumer. If you are planning to buy a car in the next few years, expect to pay more. With tariffs increasing costs and manufacturers cutting production, prices are climbing faster than ever. Layoffs in auto plants and related industries mean fewer jobs, less spending power, and widespread economic strain. This is no longer just a trade dispute. It is a full-blown crisis affecting everyone. With no easy fix in sight, the United States is at a crossroads. Either it adapts to this new trade reality or it risks being left behind. The question is, how will Washington respond? What do you think? Let's know in the comments.